Hello everyone, welcome back to our channel. But if you're new to this channel, please click the subscribe button and your like button so you can help this channel to grow. In this video, let us talk about the latest report of Bigcommerce. Big C had reported their first earnings report as a public company last September 9, 2020, grossing a revenue of $36.3 million, beating analyst estimates of $35.61 million, while earnings per share is at negative 0.38 compared to estimate of negative 0.58. The earnings report is not bad actually, but it's not overwhelming either, as year-over-year earnings growth is just 33% compared to Shopify's 97% revenue at the midst of pandemic, which everyone is expecting to have an exponential growth. So what? Am I changing my opinion about this stock? Actually, I'm not. I am still maintaining my opinion about this stock as a buy, maintaining it for a long-term hold for this foregoing investment thesis. Big C had strengthened its fundamentals by increasing their gross profit margin to 78.4%. Imagine that, compared to 2019's Q2 of 77%. It just means to us that they had started to earn leverage from their investment in research and development, sales and marketing, as well as the impact of collaboration among their partners as an open subscription as a service e-commerce platform. Their partner service revenue had increased to 74% year over year with 12,733,000 in Q2 compared to a year ago, which is 7,098,000 only. Research and development is the main reason why this company had incurred losses over the years. In fact, in Q2 alone, R&D is 31% of total revenue, while sales and marketing is 46%. It's not bad actually, as a growth company, they need to allocate much of their working capital on these major expenses to challenge the players in the industry. Particularly that they are operating in a very competitive sector, in which innovation is the key to success. In this regard, Big C had rolled out their page builder at the very beginning of Q2. Page Builder is a drag and drop visual editing tool which will allow merchants to build their sites differently, creating unique experience in accordance to its brand story. This is just magnificent, which could drive new accounts easily. Though, impact to financial statement isn't reflected just yet as they are running a 90 days promotion. So let's see in the Q3 the benefit of this new offering. Meanwhile, Big C annual revenue run rate is $151.8 million or 33% increase year over year. It might be little today, but it has the potential to dominate the B2B e-commerce platform as they focus on established, complex, large enterprises. Having an open SaaS platform which provides these businesses with flexibility on customization, low cost of ownership, as they do not have a transaction fees, B2B and B2C capability, that is business to business and business to customers selling, and built-in multi-currency feature, Big C has more reasons to win. In fact, in the first half of 2020, they signed 9 of Forbes' top global 2,000 corporations, including Royal Dutch Shell, Sharp Electronics, remember Sharp, it's not a small company. Jaguar, and two of the world's largest consumer packaged good companies. Make a guess, it could be Pepsi, Unilever, or Procter & Gamble. They also have La Perla, an Italian luxury apparel company. Yeti Cycles, a high-end mountain bike manufacturer. Cheryl Tree, and PayPal QRC. With these new sites built in Q2, expect bigger growth on years ahead, even in Q3 or Q4. What if Big C will decide to monetize every sales transactions to every sales it sold in its platform like Shopify? Then Big C could have increased their revenue exponentially. I always mention about growth and I always select a company having a growth potential. And Big C has these levers of growth which is very strategic. Accordingly, first, they grow when their merchants' business thrive and grow on their platform. This strategy actually is good being a customer-oriented business, as their pricing on essentials and enterprise plans is designed to adjust as sales volumes increases over its tier. 2. They grow by acquiring new merchants of all sizes for SMB small medium businesses to mid-market to large enterprises. They seek to extend their sales and share in high growth industry or high potential industries, customer segments, and use cases per their earnings report. A major industry example in B2B which generates roughly a third of all their e-commerce platform being spent and is faster growing than B2C. They estimate actually that about 10% of their customers globally are primarily B2B sellers. Third, they grew by expanding their product and go-to-market capabilities in geographies around the world. Big C had served over 120 countries in the world in different languages and currencies. In Q2, in fact, they have 65% year-over-year increase growth in EMEA countries, that is Europe, Middle East, and Africa, while 38% revenue growth in Asia Pacific. They have enhanced as well the self-service usability and new geographies by translating their control panel in the local languages and enabling integrations for their local payment processors. They also recently launched an international marketing sales office in France, Italy, and Netherlands. With this development, with this proactive strategy, Big C could expand their market globally, and therefore we can expect that their sales growth in the near future would be higher. They also grow by expanding their technology ecosystem and their revenue share and partnership. Accordingly, one of their partners as payment processor is Square and PayPal. So these two big corporations could give value added to Big C's business environment. Also, on a perceived growth sector of the market, investing heavily in technology to meet the needs of their target customers, having a robust feature sets for their customers like unlimited SKUs, age to built-in multi-currency feature, Big C is hailed by Gartner as a challenger to software leaders. As People, which tripled its revenue under the wheel of Bigcommerce, said, "We started People on Shopify and grew really quickly over that first year. Shopify was a decent fit when the company was relatively small and didn't have a lot of SKUs and product variants. However, as we scaled, we began running into product limitations and the hacks to figure out how to become very convoluted. It was difficult for us to figure out how to get the layouts and the product options that we wanted. After a few months, it was clear that we needed a better category system and more robust features to continue growing our e-commerce store. Looking at their balance sheet, the company looks like in financial trouble, having a debt-to-equity ratio of negative 45.35% due to cumulative deficit of $291,079,000 and total ratio of only 0.65. It means that for every asset of the company, they only have $0.65 as payment for every $1 of debt. Though their current ratio increases from 0.98 in December 31, 2019 to 1.48 in Q2, which to me is good, so their liquidity position is not that a problematic one. But these numbers will change in Q3 because on the effect of their initial public offering in which they have a net cash proceeds of $175.8 million net of underwriters discount and commissions. I always look at the liquidity and solvency of the company. However, on this one, I won't consider it that much because this is a growth stock. Though I would agree that Big C at the current market price at the closing of September 11, 2020 with $82.87, it is expensive. Having a high price to sales ratio of 43.03. A market capitalization of $5.54 billion with that kind of revenue level. Though their price to sales ratio is quite better than Shop, which is 53.06, but it is extremely high against Salesforce of 11.92. However, Big C won't open at $68 on the first day of trading for nothing. It has the potential to grow, which institutional investors or their early big investors had perceived. Alright guys, what is the best entry point for Big C stock? I believe that the best price for Big C is below $50 or let's say below $30. But will Big C would pull back to this level considering that they have a low float which is 25.35 million shares or 41% of its total outstanding shares of 61.28 million. Analysts' 1-year estimate for this stock is at a high of $132 with a low price at $52, resulting to a fair value estimate of $105.33. Personally, I don't think the price would drop below $50 unless insiders would start selling their own shares. But they have a lock-up period until February 5, 2020, which is 180 days from its IPO date, in which we could expect a reduction on price at least 10%. So if using their 52-week low of 63.77, then we can expect at least a minimum price point of $57. Unless institutional investors would start selling their own shares then. So we might have the chance to buy the share below $30. But it's all purely speculative, right? So if you will ask me then, it's better to have any price point nowadays and then just add a little or just add more when Big C would drop into a new low price level. That's all for today, guys. So if you like this video and you find it helpful, please click the subscribe button and your like button so you can help this channel to grow. Also, add your comments and I will answer it right away. And also your notification bell so you'll keep updated on my upcoming videos. I'm dropping a video at least once or twice a week.